Something is broken in the silver market, and what's broken shouldn't be possible according to everything we know about how markets are supposed to function. Right now, silver is climbing, not crashing, not stagnating, climbing. And it's doing this while the speculative community that normally drives precious metals volatility has almost completely abandoned the market. Open interest on the COMEX, the number that tells us how many active participants are actually trading silver futures, has collapsed by 40% in the last 18 months. The trading floor that used to roar with activity is now essentially a ghost town. When speculators leave a market, when participation collapses, when liquidity drains away, the price is supposed to fall. That's not opinion. That's basic supply and demand mechanics that have governed financial markets for centuries. Fewer buyers means lower prices. Every economics textbook ever written will tell you that. But silver isn't following the textbook. And the reason it's not following the rules should be setting off alarm bells in every serious investment institution on this planet. Because what's holding silver's price up while the paper traders walk away is something far more concerning than speculative momentum. It's $1.3 trillion in leveraged margin debt sitting on a trigger, combined with quiet, deliberate accumulation happening in time zones most Western investors aren't even awake to see. This is Bullion Eye, where we analyze precious metals markets with the clarity and honesty your financial decisions deserve. I'm here to walk you through exactly what's happening in silver right now, why it violates every normal market pattern, and what the data is telling us about where this situation is heading in the next 30 to 90 days. Before we go further, if this is your first time here, hit that subscribe button. Think of it like installing a smoke detector. You don't wait until you smell smoke. You do it now because early warning systems matter. One click, do it now. And while you're down there, drop a comment telling me where in the world you're watching this from. New York, London, Mumbai, Lagos, Sydney? This isn't just an American story. This is a global financial market event in progress, and I want to know who's paying attention. The anomaly that shouldn't exist. To understand why what's happening in silver right now is genuinely alarming, you first need to understand what normal market behavior looks like, and more importantly, why silver is deviating from that normal behavior in ways that have no precedent in modern commodity trading history. In a functioning market, price and participation move in correlation. When more traders enter a market, when more capital flows in, when more speculators place bets on future price direction, the price typically rises because demand is increasing. Conversely, when traders leave, when capital withdraws, when speculative interest collapses, prices typically fall because there are fewer buyers competing for the available supply. This relationship isn't perfect. Markets are complex systems with many variables, but the correlation is strong enough that when you see major deviations from this pattern, serious analysts start asking hard questions about what's really driving price action beneath the surface. Silver right now is showing us one of the most extreme deviations from this pattern ever recorded in commodity market data, and I don't use the word extreme lightly. 18 months ago, COMEX silver futures open interest, the total number of active contracts representing positions that traders are holding, stood above 185,000 contracts. That represented a healthy, liquid, well-participated futures market. Hedge funds were active. Algorithmic trading systems were engaged. Speculative capital was flowing freely through silver positions. Today, that open interest number has fallen to approximately 115,000 contracts. That's not a minor decline. That's not normal market fluctuation. That is a 40% collapse in participation. 40% of the speculative community that was actively trading silver futures 18 months ago has left the building. They've moved their capital to technology stocks, to currency trades, to cryptocurrency markets, to wherever momentum and volatility are creating short-term profit opportunities. They've left silver behind. The COMEX silver pit is, for all practical purposes, a ghost town compared to what it was just a year and a half ago. Now here's where the story stops making sense according to traditional market logic. While this 40% collapse in speculative participation was occurring, the price of silver didn't crash. It didn't even decline. Silver began 2025 trading near $32 per ounce. It surged to remarkable highs during the geopolitical turbulence in late January and early February, and even after pulling back from those peaks, it has continued to hold firm and grind higher, currently trading in territory that would have been considered a breakout level just 12 months ago. Price rising, participation collapsing, these two things are not supposed to happen simultaneously, and yet, here we are, watching exactly that unfold in real time. The question every serious precious metals analyst should be asking right now is painfully simple. If the speculators have left, who is buying silver? And more importantly, why are they buying it with such consistency that the price continues to rise despite a 40% decline in futures market participation? The answer to that question is visible in the data if you know where to look. But before we get to who's buying, we need to understand the pressure that's building behind this entire situation. And that pressure has a very specific number attached to it, $1.3 trillion. $1.3 trillion locked and loaded. Right now, sitting inside margin accounts across the United States, there is $1.3 trillion in borrowed capital. Every single dollar of that money is leveraged. Every dollar represents a bet that equity markets will continue climbing, that stock prices will keep rising, that the expansion will continue indefinitely. That bet is going to lose. The only question is when. For those unfamiliar with how margin accounts function, let me explain the mechanism clearly, because understanding this mechanism is critical to understanding why silver is about to be hit with two opposing forces almost simultaneously. A margin account allows an investor to borrow money from their brokerage to purchase more assets than they could afford with cash alone. The investor puts up, let's say, $50,000 of their own money. The broker lends them another $50,000. The investor now controls $100,000 worth of stock with only $50,000 of actual capital. If the stock market rises 10%, the investor's position is now worth $110,000. They pay back the $50,000 loan, and they've turned their original $50,000 into $60,000. That's a 20% gain on their actual capital instead of just 10%. Leverage amplifies returns. But leverage amplifies losses just as aggressively. If that $100,000 position drops to $90,000, the investor now owes $50,000 to the broker, but only has $40,000 in equity remaining. The broker issues what's called a margin call, a demand that the investor immediately deposit more cash or sell assets to bring the account back to required levels. There is no negotiation. There is no extension. The investor sells, or the broker sells for them, immediately. Now scale that mechanism to $1.3 trillion, and you begin to see why this number represents one of the most dangerous pressure points in the entire financial system right now. To put that $1.3 trillion in perspective, it is 3 times higher than the margin debt levels recorded in 2007, right before the global financial crisis brought the world economy to its knees. It is 3 times higher than the margin debt recorded in the year 2000, right before the dot-com collapse erased trillions in wealth overnight. 3 times. And yet mainstream financial media is treating this like a footnote, like a minor data point that's interesting but not urgent. History teaches us very clearly what happens when margin debt reaches extreme levels and then begins to unwind. The selling doesn't happen slowly and orderly, it happens all at once. One forced seller pushes prices down. That price decline triggers another margin call. That margin call forces another sale. The cascade feeds itself and it accelerates with terrifying speed. Here's where silver enters this equation, and this is the first wave of impact that I need you to understand clearly. When forced liquidation begins at the scale we're talking about, when 1.3 trillion in leverage position starts unwinding, the selling doesn't stay neatly contained to the stock market. Investors receiving margin calls don't get to choose which assets they sell thoughtfully and strategically. They sell whatever they can sell fast. They sell whatever is liquid and available. Bonds get sold. Commodities get sold, and precious metals, including silver, get sold, not because silver is a bad asset, but simply because it's liquid, and it can be converted to cash quickly to meet the margin call demand. This is the first wave, forced selling pressure hitting silver as a side effect of equity market liquidation. But, and this is critical, that forced selling wave is temporary. It's violent, it's sharp, but it doesn't last because the capital being raised through those forced sales doesn't just disappear into thin air, it goes somewhere. And after the panic subsides, after the liquidation completes, after the margin calls are satisfied, that capital begins looking for a place to go that feels safer than the market that just burned it. When paper assets collapse, when stocks fail to protect wealth, when bonds don't deliver the safety they promised, capital flows toward assets that can't be printed by a central bank, assets that have held value across centuries, assets that exist in physical form and can't be erased by a software update or a policy decision. It flows toward gold, and it flows towards silver. This is the second wave, capital flight into hard assets following the initial liquidation event. And this second wave is where silver's story gets genuinely explosive, because the silver market in its current condition is structurally unprepared to absorb that kind of capital inflow. Hit that like button right now if this margin debt analysis is connecting dots you hadn't considered before. Every like tells the algorithm that this information matters and helps this video reach people who need to see it before the unwind begins. The market that emptied. While nobody was watching, the COMEX silver futures market serves a very specific and critical function in the global precious metals ecosystem. It's where the paper price of silver gets determined every single trading day. The futures contracts traded on COMEX, the speculative positioning, the hedging activity, all of this creates the price discovery mechanism that the rest of the world uses to value silver. When COMEX is active, when open interest is high, when participation is strong, the market has depth, it has liquidity. It can absorb large buy or sell orders without the price moving dramatically in either direction. That depth and liquidity is what allows the market to function normally, but when participation collapses, when open interest falls, when the speculative community walks away, that depth disappears. The market becomes thin, and thin markets are dangerous markets because they can move violently and unpredictably when any significant force, buying or selling, enters the equation. The 40% collapse in COMEX silver open interest over the past 18 months has created exactly this kind of dangerous thinness. The hedge funds that provided liquidity have moved to other markets. The algorithmic trading systems that used to create continuous bid-ask flow have reduced their silver exposure or exited entirely. The speculative capital that used to provide a cushion of depth has simply left. What remains is a skeleton market, enough activity to keep the exchange operational, but nowhere near the participation levels needed to absorb large-scale buying or selling without significant price volatility. And here's where the situation becomes genuinely concerning. The price should have fallen when participation collapsed. Every piece of conventional market wisdom says that when 40% of your market participants leave, the price should drop because demand has declined. But silver didn't follow the script. It rose, and it continues to hold elevated levels even as the speculator exodus continues. This violation of normal market behavior can only mean one thing: someone else is buying. Someone outside the COMEX system, someone not trading futures contracts, someone operating in physical markets rather than paper markets, is accumulating silver in quantities large enough to support the price even as the entire Western speculative community walks away. The footprints of this buying are visible if you know what to look for, and those footprints don't point toward New York or London, they point east. The data shows a remarkably consistent pattern. Silver prices firm during Shanghai trading hours. They rise during Beijing market sessions. They remain supported through Hong Kong and Singapore trading. And then, when Asian markets close and Western traders take over, the buying pressure fades. The price drifts sideways or pulls back slightly until Asian markets open again the next day. This pattern has been consistent for months. It's not random. It's not coincidence. It's a signal. And that signal is telling us that physical silver accumulation is happening in Asia, while Western investors are focused on the empty COMEX futures market and concluding incorrectly that nobody wants silver. The Western investment community is looking at the paper market and seeing a ghost town. Eastern institutions are looking at the physical market and seeing the opportunity of a generation. One side is reading the COMEX data and walking away. The other side is reading the supply deficit data, the geopolitical instability, and the monetary system transition happening in slow motion, and they're accelerating their accumulation. Now, why would sovereign-level institutions in Asia be accumulating physical silver with this kind of quiet, deliberate consistency? To answer that, we need to talk about trust, or more precisely, the collapse of trust in Western financial institutions. When France stopped trusting the Fed earlier this year, something happened that should have been front-page news in every major financial publication on the planet, but it was barely covered outside of specialized financial analysis circles. France began asking serious, pointed questions about the gold it holds inside the Federal Reserve Bank of New York. They weren't asking politely out of casual curiosity. They were demanding answers. They wanted to know the precise location of their gold reserves, the exact condition of those reserves, and whether an independent audit could be conducted to verify that what France believes it owns inside that vault actually exists in the form and quantity recorded on official documentation. The response from American authorities was evasive, bureaucratic, and ultimately unsatisfying. The questions were deflected, the audit requests were complicated by procedural obstacles, and the answers that were provided raised more concerns than they resolved. For anyone who understands how the global financial system actually functions, this wasn't just a diplomatic inconvenience. It was a fracture in the foundational trust that has held the post-World War II monetary order together for nearly 80 years. The United States dollar has served as the world's reserve currency not because of legal mandate, but because of trust. Trust that American financial institutions are stable. Trust that assets held in American vaults are secure. Trust that the United States government and its financial system will honor their obligations and provide transparency when questions are raised. When sovereign nations begin questioning whether their gold actually exists where they were told it exists, that trust is no longer absolute. And when trust erodes at the sovereign level, behavior changes. Nations don't announce publicly that they've lost confidence in the dollar system. They don't hold press conferences declaring that they're moving away from dollar-denominated reserves. They act quietly. They repatriate gold when possible. They diversify into hard assets they can control directly. And they begin accumulating physical precious metals that they can store domestically without dependence on foreign institutions. Gold is the obvious first choice for this kind of accumulation, but gold is expensive, widely watched, and immediately noticed when sovereign buying begins at scale. Every major gold purchase by a central bank is reported, analyzed, and discussed in financial media. Silver is different. Silver is smaller per unit. Silver is cheaper. Silver moves under less scrutiny. And critically, silver carries a dual value that pure monetary metals don't possess. It's simultaneously a monetary asset and an industrial necessity. For a nation building infrastructure, expanding manufacturing capacity, deploying massive solar energy programs, and producing electric vehicles at scale, silver isn't just a store of value. It's a strategic industrial resource that will be needed regardless of what happens to the global monetary system. This dual functionality makes silver uniquely attractive for sovereign accumulation in the current environment. It hedges against monetary instability while simultaneously securing supply for industrial development that's already locked into 5- and 10-year national plans. The pattern we're seeing in Asian trading hours, consistent, patient, disciplined accumulation that doesn't spike dramatically but builds steadily session after session, has all the characteristics of institutional or sovereign-level procurement operating on a long-term strategic timeline. This isn't speculative trading hoping to catch a short-term price move. This is procurement, strategic resource acquisition, and the West is almost completely blind to it because Western financial media is built around paper markets, futures positioning, and speculative sentiment indicators that don't capture physical metal movement through Eastern exchanges and private vaults. Drop a comment right now and tell me, are you seeing this trust fracture playing out in other areas of global finance, or do you think this is isolated to precious metals? I want to know what you're observing from where you are in the world. 3 forces on a collision course. We now have 3 separate forces moving toward the same narrow window of time, and when these 3 forces converge in a market as thin and depleted as COMEX silver has become, the potential for violent price movement becomes not just possible, but mathematically probable. Force 1. The margin debt unwind. $1.3 trillion in leveraged positions doesn't require a catastrophic stock market crash to begin unwinding. It requires only a sustained correction, a 10% to 15% decline that persists long enough to trigger maintenance margin requirements across a significant portion of those accounts. When that happens, forced liquidation begins, and silver gets hit in the first wave as investors sell whatever liquid assets they can access quickly. Force 2. The COMEX liquidity vacuum. With open interest down 40% and speculative participation at 20-year lows, the silver futures market has almost no depth to absorb large-scale selling or buying without significant price movement. When the forced liquidation wave from margin calls hits this thin market, the price impact will be amplified far beyond what would occur in a normally liquid market. Force 3. The physical accumulation response. Eastern sovereign and institutional buyers who are already accumulating physical silver will view any sharp price decline caused by paper market liquidation as an opportunity to accelerate their procurement. They're not trading. They're building strategic reserves. A temporary price drop doesn't change their calculus. It improves it. Now imagine these 3 forces arriving at the same moment. Margin calls forced liquidation, creating sharp downward pressure on silver prices. That price drop hits a thin, illiquid COMEX market and amplifies the decline beyond what fundamentals would justify. Eastern physical buyers see the artificially depressed price as a gift and accelerate their accumulation. The physical buying absorbs the liquidation and then some, creating a sharp reversal that catches the remaining paper shorts completely off guard. The price doesn't move gradually in this scenario. It gaps. It skips price levels entirely because there's no depth in the market to create orderly price discovery. This is not speculation about what might happen. This is scenario analysis based on the structural conditions that already exist right now in the silver market. The thinness is real. The margin debt is real. The accumulation pattern is real. The only variable is timing. And while I cannot and will not predict exact timing, nobody can, the data suggests we're looking at a 30 to 90-day window where the probability of these forces converging reaches levels that serious risk managers cannot ignore. What this means beyond silver. For the business owners, investors, and strategic thinkers watching this analysis, the lesson here extends far beyond silver as a specific asset. What we're witnessing in the silver market right now is a case study in how financial systems behave when trust fractures, when paper markets diverge from physical reality, and when the assumptions that held a system together for decades begin to break down. The margin debt situation tells us that leverage in the financial system has reached levels that historically precede major corrections. The COMEX ghost town tells us that traditional price discovery mechanisms are failing when speculative participation collapses. The Eastern accumulation pattern tells us that sovereign-level actors are preparing for a monetary environment that looks very different from the one we've operated in for the past 50 years. Silver is simply the most visible symptom of these larger structural shifts because it sits at the intersection of monetary assets and industrial commodities, and because its market is small enough and thin enough that the forces I've described can move the price in ways that are impossible to hide. Whether you hold silver or not, whether you invest in precious metals or not, the dynamics playing out in this market right now should inform how you think about risk, diversification, and the stability of the financial infrastructure that most people take for granted. This is Bullion Eye. We don't hype, we don't speculate. We analyze the data with the seriousness and clarity that your financial decisions deserve. If this analysis helped you understand what's actually happening in silver markets right now, do 3 things. First, subscribe to this channel so you don't miss the follow-up analysis when these forces begin to resolve. We'll be tracking COMEX inventory, margin debt levels, and Eastern accumulation patterns weekly. Second, hit that like button. It matters more than you think for getting this information in front of people who need to see it. Third, comment below and tell me where you're watching from and what you're seeing in markets from your perspective. This is a global story, and I want to hear from viewers in every time zone. Critical legal disclaimer: nothing in this video constitutes financial advice. I am not a licensed financial advisor. This content is educational analysis of publicly available market data. Precious metals investing carries substantial risks including price volatility, storage costs, liquidity challenges, and potential loss of capital. You should consult with a licensed financial professional before making any investment decisions. Past performance does not guarantee future results. The analysis presented here represents interpretation of data that is inherently uncertain and subject to change. Do your own research. Verify everything independently. Take responsibility for your own financial decisions. Silver shouldn't be rising like this, but it is, and the $1.3 trillion sitting on a trigger might be about to tell us why. I'll see you in the next analysis.